Picture it for a second. You are sitting on a beach, laptop open, watching notification alerts flood your screen. Watching an endless feed of $50 and $100 checkouts process automatically. Thousands of dollars pouring in around the clock with no inventory sitting in a warehouse. No manufacturing plants and no full-time staff. That is the dream. That is the marketing pitch plastered across social media, promising a zero-risk path to passive wealth. Here is what actually happens. While dropshipping eliminates the upfront capital requirement of purchasing bulk physical inventory, it transforms those traditional balance sheet assets into high-velocity, volatile operating expenses. Some online dropshipping stores generate over $100,000 a month in gross revenue, while operating at a net loss, bleeding cash every single day. Others generate that exact same $100,000 and retain $15,000 in clean net profit. Same e-commerce platform, same third-party suppliers in East Asia, same social media ad networks, completely opposite financial outcomes. Today we are going inside the real economics of owning an online dropshipping store. Before you spend a single dollar on product testing, you need to understand what you are actually purchasing when you enter this asset class. Most beginners assume that because you do not buy inventory up front, launching a store is effectively free. That is an economic optical illusion. Let us break down the mandatory fixed overhead required just to make a digital storefront operational and competitive. You start with platform infrastructure. A standard platform subscription, like Shopify, costs between $39 to $105 per month. But a bare-bones storefront rarely converts cold traffic. To reach competitive conversion benchmarks, typically sitting between 2% and 3.5%, you are forced to build an integrated software application stack. A professional page builder costs $24 to $99 a month. Social proof and review aggregation software runs $10 to $50 a month. Post-purchase upsell application tools add another $20 to $80 a month. Customer retention via email and SMS automation starts at $45 a month and scales rapidly with contact volume. Add tracking integrations, currency conversion apps, and fraud verification scripts, and your storefront carries a fixed software overhead of $250 to $500 every single month. Before a single buyer enters their credit card, you are carrying annualized software burn of $3,000 to $6,000. And here is the part that surprises almost everyone. Your largest upfront expense isn't software, it is product validation capital. In traditional retail, market research precedes capital allocation. In dropshipping, paid advertising is your market research. To identify a single product that achieves unit economic viability, current industry data shows you must test between 10 and 15 candidate items using paid media traffic. At a baseline ad testing budget of $50 per product a day across a standard 4-day testing cycle, you are burning $200 in ad spend per product validation run. If you test 10 products before identifying a single winner, you have consumed $2,000 in unrecoverable advertising testing costs. When you combine this testing burn with payment processor holdback requirements, domain infrastructure, legal corporate setup, and sample product procurement, the true initial capital requirement to launch a functional store sits between $3,500 and $6,000. Understanding this initial capital baseline is essential because it highlights the fundamental reality of dropshipping. You are not running a retail store. You are running an ad arbitrage firm that fulfills physical goods. If you enter this market under the assumption that $100 and a laptop will build a sustainable enterprise, you are insolvent before your first campaign goes live. The initial capital is merely the price of admission to the real economic battle: customer acquisition efficiency, gross margin compression, and cash flow latency. Now that your storefront infrastructure is live, you enter the core economic engine of dropshipping, paid media arbitrage. Most people look at e-commerce through the lens of traditional retail. You buy a product cheap, sell it for more, and pocket the difference. But when you dropship, you don't own a proprietary product or a localized physical moat. You are buying attention on social media auction platforms like Meta and TikTok, and attempting to convert that attention into transaction volume at a margin higher than the cost of the traffic. To see how fragile this unit economic equation actually is, let us follow a single, real-world order. Imagine you source a trending gadget from a supplier for $15, which includes overseas line haul shipping. You list that product on your storefront for $60. On paper, you are looking at a $45 gross profit and an enviable 75% gross margin. To an amateur operator, a 75% margin feels like an unassailable financial cushion. Here is how that $45 margin disappears before your eyes. First, you incur payment processing friction. Stripe or PayPal takes 2.9% plus a $0.3 fixed fee per transaction, stripping $2.04 off your $60 purchase. If you sell internationally, cross-border settlement and currency conversion fees take another 1.5%, removing another 90 cents. Your net collectible revenue isn't $60, it is $57.06. Subtract your $15 product and shipping COGS, and your true margin before advertising drops to $42.06. Now, you turn on paid ads to acquire a buyer. On modern ad networks, you do not pay per sale. You pay for ad impressions via auction bidding, measured in CPM, or cost per thousand impressions. In primary Tier 1 markets like the United States, average e-commerce CPMs sit between $25 and $35. Let us assume a conservative baseline CPM of $30. If your video creative achieves an above-average click-through rate of 2%, every 1,000 impressions generates 20 site visitors. At a $30 CPM, you are paying $1.5 for each visitor. When those visitors land on your product page, they encounter your store's conversion rate. Industry benchmarks for cold traffic sit around 2.5%. That means out of every 40 visitors who click your ad, one buys the product. The math here is uncompromising. At $1.5 per click, requiring 40 clicks to generate one purchase means your customer acquisition cost is exactly $60. Look at the net result of that transaction. You generated $60 in gross revenue. You paid $15 for the item and shipping, and $2.94 in processing and currency fees, and $60 in advertising spend. You did not break even. You lost $17.94 on that individual order. To avoid losing money, you must calculate your break-even return on ad spend, or break-even ROAS. Your break-even ROAS is your gross order revenue, divided by your available margin before ad spend. In this scenario, $60 divided by $42.06 equals a break-even ROAS of 1.43. If your ad account generates anything less than a 1.43 ROAS, every order you process shrinks your bank account. If you generate a 1.43 ROAS, you are working dozens of hours a week for free to retain a modest 15% net operating margin, equating to $9 of profit on a $60 sale. Your customer acquisition cost must drop to $33.06, requiring a target ROAS of 1.81. And here is the ultimate scaling trap: ad account decay mechanics. When you spend $50 a day, ad algorithms target high-intent users in the top 5% conversion bucket. But when you try to scale revenue by increasing your daily budget to $500 or $1,000 a day, the ad platform is forced to bid on lower intent audiences. Your CPMs rise, your conversion rates fall, and your customer acquisition cost routinely spikes by 30 to 50%. A campaign delivering a profitable 2.0 ROAS at $50 a day collapses into an insolvent 1.2 ROAS at $500 a day. This dynamic reveals why top-line store revenue figures posted online are virtually meaningless. An operator showing $100,000 in monthly revenue at a 1.35 ROAS is losing money after software overhead and refunds, while an operator running $30,000 in revenue at a 2.1 ROAS is taking home real wealth. Once you achieve a profitable return on ad spend, amateur operators assume the hard part is over. You found a winning product, your advertising is converting, and the revenue is scaling up. But executing a digital sale is fundamentally different from settling clean cash in your bank account. As you scale transaction volume, you immediately slam into the operational choke points of the dropshipping model: supply chain latency, gateway reserves, and return leakage. Let us start with supply chain latency. In a traditional e-commerce operation, your inventory sits in a domestic third-party logistics warehouse, or 3PL. A customer orders on Monday, and the product is delivered to their doorstep by Thursday. In the standard dropshipping model, your product is dispatched from a manufacturing hub in Shenzhen or Yiwu. Even utilizing expedited direct-line shipping services, you are looking at transit times of 7 to 15 days. In an era where consumers are conditioned by major retailers to expect 2-day delivery, a 15-day fulfillment cycle is not just an inconvenience. It is a severe financial liability, because during that 2-week latency window, you are exposed to the most dangerous mechanism in dropshipping: the payment processor risk algorithm. Payment gateways like Stripe, PayPal, and Shopify payments are not your partners. They are financial institutions managing risk exposure. When their systems detect a sudden spike in revenue tied to a new entity with no corporate credit history, fulfilling goods from East Asia, warning sirens go off. They know that a 15-day delivery window dramatically increases the statistical probability of customer disputes. To protect their balance sheets, the payment processor will trigger a rolling reserve. This shocks most new operators. Without warning, the processor will lock 10 to 25% of your gross daily revenue in a holding account for anywhere from 30 to 90 days. Imagine you successfully scale your store to $5,000 a day in sales. You are spending $2,500 on ads to acquire those customers and $1,500 on supplier costs to fulfill the orders. On paper, you are generating $1,000 in daily profit. Instead, a 20% rolling reserve is instituted. The payment gateway freezes $1,000 of your daily payouts for the next 60 days. Suddenly, your usable cash flow drops to zero. Even though your store is technically profitable on an accrual basis, you are functionally insolvent on a cash basis. You are forced to fund tomorrow's advertising spend and supplier invoices entirely out of your own depleted working capital. If the shipping latency does not crush your cash flow, the return leakage will. In traditional retail, a 10 to 15% return rate is standard. When a customer returns a sweater to a major brand, it goes back on the rack. But when a customer wants to return a dropshipped gadget, where does it go? International return shipping to China for a $15 item routinely costs upwards of $25. It is economically irrational to send the product back. Instead, you are forced into what is known as a blind refund. You tell the customer to keep the product, and you return their money. Let us put real numbers to this leakage. Assume you sell a product for $60. Your acquisition cost is $30, and your product cost is $15. You made $15 in profit. If that customer demands a refund, you lose the $60 revenue. But you have already burned the $30 on ads and the $15 on the supplier. You just took a $45 absolute loss. To recover that single $45 loss, you must successfully acquire and fulfill 3 entirely new orders at your standard $15 profit margin just to break back to zero. And if the customer bypasses your support desk and files a chargeback directly with their credit card company, the math gets even worse. The bank immediately and forcibly deducts the transaction amount from your account while slapping you with a fixed chargeback penalty fee of $15 to $25. If your store's chargeback ratio eclipses just 1% of total transaction volume, you will be placed on a high-risk monitoring program. Eclipse 1.5%, and you face a permanent merchant account ban, effectively liquidating your business overnight. When most beginners think about scaling a business, they assume it is a linear process. You spend more money on ads, sell more units, and make more profit. But in dropshipping, rapid scaling is often the exact mechanism that destroys the enterprise. This is due to a fundamental financial phenomenon known as the cash flow latency trap. To understand how rapid growth triggers bankruptcy, you have to track the exact timeline of money moving into and out of your operation. Imagine your store hits a viral trajectory. On day 1, you scale your daily ad budget from $100 up to $2,000. By midnight, those ads generate 100 orders at $60 each, producing $6,000 in gross revenue. Your ad bill for the day is $2,000, and your supplier invoice to fulfill those 100 units is $1,500. On paper, you just had a phenomenal day, clearing $2,500 in net profit. Here is what actually happens to your bank balance. Your advertising platform, whether it is Meta or TikTok, bills your credit card in real time or on short threshold triggers. That $2,000 ad expense hits your balance sheet immediately. Meanwhile, your supplier in China requires payment before they will generate shipping labels and dispatch the orders. That means you must pay your supplier $1,500 upfront on day 1. To cover day 1's operations, you need $3,500 in liquid capital immediately available. Now look at your incoming cash flow. Your payment processor collects the $6,000 from your customers, but payment gateways do not settle funds instantaneously. A standard payout schedule operates on a 2 to 3 business day rolling payout window. Throw in a weekend and your funds are held for 5 calendar days. Furthermore, if you triggered a standard 15% rolling reserve due to the sudden volume spike, $900 of that revenue is frozen for 90 days. On day 1, you spent $3,500 in hard cash, while receiving $0 in collectible payouts. Repeat this on day 2, day 3, and day 4 as you continue scaling. By day 5, you have spent $14,000 on advertising and paid $10,500 to your supplier, $24,500 in total cash outflows. Yet your payment gateway has only just initiated its first payout, delivering less than $5,000 after accounting for processing fees and reserves. You are facing a negative cash float gap of $19,500. If you do not possess $20,000 to $30,000 in liquid working capital or high-limit corporate credit lines to bridge this float gap, your business grinds to a catastrophic halt. You are forced to turn off your ad campaigns, killing your momentum. Worse, if you cannot pay your supplier upfront, order fulfillment freezes, leading to shipping delays, angry customers, a spike in chargebacks, and an eventual account ban from your payment gateway. This is the scaling paradox. The faster you grow, the more cash you consume, making rapid growth a cash-hungry monster. To survive this operational bottleneck, professional operators are forced to restructure their supply chain as they scale. You cannot scale a multi-million-dollar store relying on generic platform apps or AliExpress suppliers. You must transition to a private sourcing agent or a specialized logistics fulfillment partner. A private agent acts as a middleman operating directly out of major manufacturing hubs. They consolidate your orders, negotiate volume pricing with factories, and secure access to premium, dedicated shipping lines that cut transit times down to 6 to 10 days. However, migrating to private agents and custom inventory workflows introduces new capital requirements. To lock in lower unit costs and guaranteed shipping slots, agents often demand minimum order quantities or deposit balances paid via wire transfer, eliminating the safety of credit card float. Ultimately, scaling a dropshipping store is not a marketing problem, it is a capital management problem. An operator who understands cash flow cycles, maintains strict reserves, and manages float latency can turn growth into real equity. An operator who ignores the cash flow gap will find that hitting their biggest revenue milestone is the very thing that drives them into insolvency. When investors evaluate a business, they are not paying for what the company earned yesterday. They are buying the probability of future, defensible cash flows. In software, that defensibility comes from code and switching costs. In real estate, it comes from land and physical structure. In direct-to-consumer e-commerce, it comes from brand equity, customer loyalty, and proprietary supply chains. Which brings us to the ultimate financial reality of dropshipping, the asset value paradox. You can build a dropshipping store that generates $1 million in gross annual revenue and nets $150,000 in operating profit, yet discover when you try to list that business on an e-commerce brokerage that it is worth almost nothing. To understand why, you have to look at how e-commerce assets are valued. Business valuations in the e-commerce sector are typically calculated as a multiple of SDE, seller's discretionary earnings. A traditional direct-to-consumer brand that owns custom product molds, holds inventory in domestic warehouses, and maintains a patent portfolio, typically trades at a multiple between 3 to 5 times seller's discretionary earnings. If that brand earns $200,000 in net seller's discretionary earnings, its enterprise value sits between $600,000 and $1 million. A pure dropshipping store, by contrast, commands a valuation multiple between 0.5x and 1.5x SDE if it can find a buyer at all. More often than not, its terminal value is 0. Here is why institutional buyers refuse to pay a premium for dropshipping operations. First, dropshipping stores possess zero economic moat. Because you are sourcing unbranded, off-the-shelf items from public supplier directories, your barrier to entry is non-existent. The moment your ad campaign goes viral, competitive research software flags your winning product. Within 48 hours, dozens of competitor storefronts launch with identical video creatives, copied landing page copy, and identical suppliers, bidding up your ad auctions and destroying your margins. Second, dropshipping operations suffer from abysmal customer lifetime value. A healthy e-commerce brand targets a repeat customer rate of 30 to 50%. This creates a compounding annuity effect, where high-margin back-end email and SMS channels generate predictable, zero acquisition cost revenue. A standard dropshipping store, due to long shipping times and generic unboxing experiences, regularly suffers a repeat customer rate below 5%. You are forced to rebuy every dollar of customer revenue from social media ad networks every single day. The moment you stop spending money on ads, your revenue collapses to 0 instantly. You haven't built a business. You have leased a temporary cash flow stream from Meta and TikTok. And third, you face complete supply chain fragility. You do not own your manufacturing relationships or shipping lines, or your product intellectual property. If your supplier runs out of raw materials, raises unit prices by 30%, or begins fulfilling orders with inferior components, you have no contractual recourse. This is why sophisticated e-commerce operators treat dropshipping not as an end-state business model, but as a capital-light market research laboratory. The smartest operators use dropshipping exclusively to test product concepts, using paid media traffic without risking bulk inventory capital. But the second a product hits product-market fit, generating consistent daily volume at a viable ROAS, they immediately kill the dropshipping infrastructure. They take the cash flow generated during the testing phase and reallocate it into real business infrastructure, placing bulk purchase orders directly with Tier 1 factories, securing custom product molds, moving stock to domestic 3PL fulfillment centers, and engineering custom packaging. By transitioning from dropshipping to a traditional inventory-backed brand, they compress shipping times from 12 days to 3, lower unit product costs by 30 to 50%, spike their repeat purchase rates, and transform a temporary ad arbitrage campaign into a sellable 4 times multiple enterprise asset. Dropshipping is not a passive wealth-building machine, nor is it a sustainable long-term retail business. It is a high-velocity, high-stress capital allocation tool. If you approach it like a low-effort shortcut, the brutal math of customer acquisition and cash flow latency and zero terminal value will eventually wipe you out. But if you respect the underlying mechanics, manage your working capital float, and use the cash flow to build a defensible brand, it remains one of the most powerful launchpads in modern finance.